Everyone talks about having a trust, but can you spot the difference for a trust that's there because of statutory regulations and a trust that's actually there to help you build your wealth? Majority of the population can't. But after watching this video, you will be in the wealthy minority that actually understand. Welcome to What Schools Should Have Taught You, a podcast where I share with you all the lessons you need to know about building true wealth. I'm Jeremy Iannuzzelli, and we're going to talk about the 4 types of trusts, the things that actually mean something to you, where it's going to help you grow your wealth, and what's there from a statutory regulation point of view.
Everything schools should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything schools should have taught you so you can build the life you want.
We're going to start with the very basics. What are the 4 different types of common trusts? Our first one, most commonly, is our discretionary trust, or colloquially known as a family trust. Our second trust is a fixed trust, or otherwise known as a unit trust. Our third most common trust is a bear or custodian trust, commonly used for the purpose of purchasing property in super under limited recourse borrowing arrangements. And our last trust, little less known, but equally as important, is a testamentary trust, a trust that's established as part of the will. Now, if you've heard all my prior YouTube videos and podcasts for the people listening on Spotify and iTunes, you would hear that I'm really trying to hammer in and speak to everyone a lot about what a testamentary trust is. Not many people understand it or have been told about it. It's always been reserved for the rich, but we'll come to that at the very end. I'm going to start today with a discretionary trust. Now, again, commonly heard and a theme throughout all of my videos, but we'll go a little bit deeper into it so you understand how the wealthy really use it. Number one, we all know that it protects our assets. It's a great way to have an entity that you control but do not own. It's the benefits that it provides you from a tax minimization point of view, which gives you an opportunity of distributing profits to all of the beneficiaries stated in the deed. A little less more known, but now commonly and frequently getting used, is the borrowing capacity benefits that come and are enjoyed with positive cash flow trusts or positive geared trusts. Now again, something that you'll hear from many brokers, but some conditions still remain. And those conditions are that the property needs to be, all the assets inside the trust need to be positive cash flow, able to meet their own commitments without any capital required by you as a director of the trustee, a trustee, or a beneficiary. If you can meet those standard conditions, then you can negate the debt within inside that trust, giving you an opportunity to re-borrow and utilizing your borrowing capacity to purchase, say, in a separate entity. Very commonly used now and very much used among sophisticated investors and investors wanting to grow their portfolio from a property and share point of view. Our second trust that a lot of people are starting to use when we're bringing together multiple people in a transaction. Now, in times where interest rates are a lot harder and capital's a lot harder to obtain as well, many people are putting their resources together. And a fixed trust, or commonly known as a unit trust, is a great way to do it. Again, it gives you asset protection because you're separating the asset from your own personal name, but gives you an opportunity to structure the income that that unit trust derives to the unit holders in your own entity. And that entity could be a company or your own discretionary trust. It gives you ample opportunity of being able to minimize the tax and be able to push that money around the way you need to minimize your tax and put more money in your back pocket. So there's ample reasons why unit trusts really work well when you're bringing together multiple layers of parties that are invested into one asset. Our third trust, more commonly used for a lot of self-managed super fund borrowers, is a concept called a bear or custodian trust. Now again, this is the only way that you can purchase property with leverage in super, otherwise known as the limited recourse borrowing arrangement. It's a special way that you obtain property finance where the custodian and bear trust owns the actual property on behalf of a trustee and the loan is taken out via the super fund itself. When the property is all paid off, a special transfer occurs with very minimal stamp duty, I should say, just a token application fee, but no capital gain tax. Now, believe it or not, self-managed super fund lending and purchasing utilizing a custodian and bear trust is one of the safest ways. Why? Because the bank can only secure the debt against the property, or the bank can only secure the debt against the asset. So it means it can't come after any of the other assets inside the super fund. Cheekily, what I have seen some banks do as of late is they have been getting the directors of the trustee, the bear trust that is, to be able to guarantee the loan. Very cheeky banks, but essentially what they're trying to do is trying to get a guarantee on the debt that they are providing the trustee, which is holding the property on behalf of the bearer or custodian trust. But the benefit is that they can't come after any other assets within inside the fund, which will include other cash or potentially shares and other assets that it holds. So it's a very great way to be able to buy property, to be able to loan or leverage for shares under special conditions with special banks that provide the products. And our last trust, again, spoken about in numerous videos. If you had a chance, go back and listen to all the prior videos. At the same time, don't forget to smash that like button and follow if you're on Spotify or on iTunes. But our last trust is our Testamentary Trusts. Not many people are aware of the benefits that it provides. Now, I've spoken about it in numerous episodes, but again, to reiterate it, a testamentary trust is completed through the will. It's not actually established until the person passes away and then established either by the accountant or the solicitor who is assisting with the administration of the will. A testamentary trust has some significant advantages to it. What's one of the first advantages? All of the assets of the individual who's passed away, the assets roll over into this special trust. It allows them to create some conditions, essentially ruling from the grave, although we can't do that, but it gives them very much similar powers. Number two, it allows minors, again, who are beneficiaries of the testamentary trust, to be taxed as adults. A significant benefit. Minors, if receiving a distribution, are taxed at the highest rate, where in a testamentary trust condition, they're taxed at adult rates. So it's a great way to preserve the capital and a great way to preserve the income that the estate testamentary trust is distributing to the beneficiaries of which it's entitled to utilize it for. So these are some of the major trusts that a lot of the wealthy are using to be able to make sure that they're gaining significant advantage over the people without the money or the knowledge. Today is just giving you a little bit of a taste of everything you need to know about the 4 trusts the wealthy are using to take advantage and to grow their wealth a lot more faster. So I just want to give you some call to action and some summary today. Number 1, we spoke about a discretionary trust, really good for being able to distribute profits and minimize tax. Also some significant borrowing advantages there, so some great opportunities. Second trust, fixed or otherwise known as unit trust, great way to bring multiple people together and then being able to minimize your tax through your own entities, which is a fantastic result for both or numerous parties. Our third trust, custodian and bear trust, again, great way to protect our assets, more commonly used for self-managed super fund borrowing. And our last trust is a testamentary trust, a great way to enhance when you roll over your assets to your family after your passing, and some significant tax advantages involved, especially being able to distribute to minors. Get in contact with the professionals if you need to. There's a lot of ins and outs you need to know, and knowing how these 4 trusts work can save you a lot of tax, make you a lot of money, and protect your assets. I'm Jeremy Iannuzzelli, and that's what school should have taught you.